We're going to get started. First, I'd like to introduce myself. I am Angela Daisy. I am Vice President here at EXL, and I have the privilege of being the lead for the Marketing Solutions, Banking, and Financial Services clients. Thank you again for joining us today. With me today is Nikki Carney, Vice President and Head of Digital and Lead Generation for EXL, as well as Joe Grillo, VP and Head of Marketing Analytics for EXL. Thank you both for joining us. Today, we have a really jam-packed agenda. We are going to give you a firsthand account of how we have used EXL's addressable media solution for client growth. Then I'm going to ask our panelists to really dive into the strategy as well as the data and analytics magic behind it. From there, we're going to discuss the overall business impact of this solution for EXL's clients and excitingly take some of your questions. Please note that in the bottom of the screen, we'd ask the audience to send us some questions throughout this session so we can include them in the section at the end. So with that, let's get started. As I mentioned, I work with our banking and financial services clients here in the Marketing Solutions Group. Recently, one of our clients came to us with a challenge. They are a regional credit union who, like many in this space, are looking to grow deposit assets. However, to date, their growth had been stunted by not being able to directly attribute new accounts or balances to their digital marketing efforts. This is where EXL's team came in with our addressable media solution. This solution is data-driven and utilizes custom lookalike models so that prospecting is done based on existing member attributes. Our team launched a 6-week media flight that was multi-channel across social, CTV, OTT, and programmatic display. The outcome delivered results more than 3 times greater than the goal. And this campaign alone brought in over 2,000 new members at an $85 cost per member acquired. Additionally, for every marketing dollar that was spent, $35 in balances were generated. So, Nikki, I know this was a slam dunk for this client, but when we got started, it was all about identifying a better, more targeted yet scalable media solution to achieve their goals. Can you walk us through how we got started, the strategy behind this success?
Absolutely. So before we actually jump into what that winning strategy was, I want to quickly highlight a few common problems that, similar to what Angela just mentioned, a lot of brands have difficulty overcoming. So one of the most common roadblocks, is scale. Many marketing portfolios rely heavily on bottom funnel tactics. And since these campaigns are demand-driven or their audience pools are reliant on other marketing efforts, their scale is really restricted. Another common problem is attribution. Most marketers, whether they like it or not, leverage a last-click attribution model, which we know can over-attribute conversions to lower funnel campaigns, making it very difficult to show the true value that mid and upper funnel campaigns have on the marketing portfolio. The third problem that many people face, especially in the banking and financial services vertical, is targeting. Many brands still heavily reliant on direct mail, and in this space, because the use of credit data is allowed for targeting. But it's significantly more difficult to obtain this level of precision targeting and remain compliant in the digital space, which leads to inefficient and broader targeting, lowering your overall approval rates and driving up your cost per acquisition. And where does that get us? Well, if you can't prove the value and impact due to attribution limitations, and you can't narrow your audience based on higher converting criteria, then how are you going to get the budget to test and expand if the bottom line just won't pencil? And why won't that pencil? So we believe that it's because of the media approach. Typically, with a conventional media approach, the targeting is really, really simple. You're using anonymized segments trapped in the walled gardens. The impression quality is also lower because it can be plagued with invalid bot traffic and unviewable below the fold impressions. And the spray and pray approach leads to fluctuating and unreliable pacing. And finally, and probably most importantly, the tracking and attribution is limited in many cases to only clicks and in-platform conversions. Now, EXL's media strategy solves for these downfalls of the conventional approach. First, we have a very sophisticated and unique targeting approach. We leverage high-quality third-party data and targeting models developed by a combination of AI and humans. very smart humans with advanced degrees. Our team has developed a modeling methodology that is comparable to the precision achieved in direct mail that uses credit data, but in a manner that is compliant to use digitally. Leveraging EXL's proprietary and exclusive financial quality score, or FQS. And Joe's going to go into that a little bit more detail about that in just a couple of minutes. Additionally, we buy quality impressions with high viewability media placements while incorporating best practices to ensure your brand safety and prevent costly annoyances like invalid bot traffic. Our addressable media approach also ensures a controlled delivery because we spend your money like it's our own, so we don't waste any budget on hitting the same person too many times. And finally, this approach wouldn't be a success if we weren't able to prove it, which is why our approach is highly measurable. We know what was generated from every marketing dollar spent down to the policy and the premium detail. So how exactly does this all work to drive the results that Angela spoke about? It starts with your ideal customer or prospect. Our data scientists will leverage first and third-party data and predictive models to identify key target audience attributes to build the audience model. These models are customized for each brand, product, and campaign, taking into account a variety of contributing data points like demographics, triggers, geo, risk scores, summarized credit data. EXL partners with all of the major credit bureaus, which puts more than 6,000 variables at our fingertips to incorporate into these models. And Joe's going to dive into that a bit more shortly as well. Your custom model is also weighted based on attributes like product fit and approval likelihood. Then for a prospecting campaign, a lookalike audience is created. This lookalike audience, unlike those created in the platforms, has PII, which is a critical component to our addressable media matchback process. We know exactly the person we are targeting, and that audience is securely loaded into the selected media platforms so we can find that target where they consume their media. Then we drive multiple touches across various platforms and creative units to build that interest, educate, and ultimately drive that prospect to convert wherever they want, online, in your app, over the phone, or even in a branch. And we can attribute those conversions back to the media, regardless of where they converted, because we know who they are. Their data is not anonymized to us like walled garden audiences. You will never know who Facebook targeted in one of their lookalike audiences because you're not privy to their PII. When EXL's methodology matchback process is leveraged, our analytics team identifies every person who was exposed to media and then matches them to those that converted on the back end. Highly measurable. Then everything comes full circle, and that data is used to recalibrate the targeting model so the customized model evolves and improves over time. Simple, right? So one more important component that contributes to this approach's success is the media mix. Not only is the targeting customized, but so is the media selection, which is critical to achieve success at scale. And to accomplish success at scale, we implement a multi-channel and multi-platform strategy so we can maximize the match rate and the reach. Nowadays, it's so important to find the audience where they consume their media. And with the ever-growing number of ways to consume media nowadays, we can't rely on just one or two channels. Many marketers' methodologies isolate channels and platforms to test them in silos. And if they can't perform on their own at the same levels as other efforts, they're often abandoned, which consequently can stunt growth. Our expert team develops a customized media mix, taking into consideration all possible channels and platforms that accept first-party data. The combinations are truly endless with so many available platforms: Facebook, Instagram, Pinterest, TikTok, Reddit, X. And those are just some of the paid social platforms we leverage. We also layer in premium inventory through the trade desk so that we can find your target audience, whether they're reading an article on Forbes.com, binging their favorite show on Hulu, or listening to their favorite podcast on Spotify. So ultimately, our addressable media strategy helps you fill the funnel with a quality, selective audience then delivers your message wherever your audience consumes their media, so they can move through the funnel and convert at scale and cost efficiently.
Thank you, Nikki. Really appreciate that insight. It's clear that the media strategy behind this is so different than, say, traditional media, as you mentioned. But at the core for this solution really is the targeting, which is driven by data and analytics. Joe, your team finds a way to bring these strategies to life, like Nikki was saying, by finding the right people, by determining the right offer, by, where are they going to be? So can you give us a little insight into how the magic works?
Great, thanks, Angela. Yeah, first I want to talk about the right customer. And for me, the right customer starts with looking for risk or prospect quality. In the financial and lending world, this is extremely important. And in direct mail, we're able to achieve this by using individual credit down at the individual level. However, as Nikki mentioned before, we're not able to do that from an FCRA compliant basis in digital and media channels. So it leaves us with a conundrum of how do we control for that risk quality or prospect quality. What EXL has done is developed a financial quality score, FQS, that is a credit surrogate that enables us to execute at the individual level, but ensure that we get similar to exact same risk quality through the digital and media channels. So what we've done is use a combination of summarized credit and individual attributes to develop this financial quality score. And what we found is it predicts credit score at a 70% or higher accuracy. The more you get market, the higher that accuracy rate will be because you're cutting fewer people out of the campaign. And what this allows us to do is to get more confidence in what we're doing from a digital perspective on the risk side, but enjoy the value that we can have on the marketing efficiency side, because the digital and media channels tend to be less from a cost per basis. And then once again, what's most important is because we're not explicitly using credit data, we meet the the FCRA requirements, and we can compliantly use this score digital first presentment, thereby controlling for the risk quality. The second piece of targeting really comes into that combination of first party and third party data that Nikki described earlier. Again, what this enables us to do is to try to satisfy the customer lifetime value that meets the product's demand or the bank's or financial services demand. And, strictly speaking, that's finding customers who are likely to respond, convert, pay, and stay. In order to do so, we'll build a series of predictive models based on third-party data, matching it to the first-party data, and we're able to then determine who are the folks that are most likely to return value, and with the FQS score, return value and be a proper risk for the program that we're marketing for. Because we're able to do this at the individual level, that then enables Nikki to be able to leverage that in the media types and upload that via, our partners or LiveRamp or the trade desk. The last point that I'd make about this is because all this information is available at the front end, we're able to predict the likely customer lifetime value at the time of solicitation. And then we're able to validate that, which we'll come on to in just a moment. When we're thinking about responsiveness, though, all consumers are not made equal, as we know, and not all consumers will respond the same way to different media types. So what we found is, traditionally, these methods were displayed in direct mail, wing to wing. But what we did find is obviously what makes a mail responder automatically make what a digital or media responder. So on the left-hand side, what we're trying to illustrate here is we built a model for the direct mail, and we ranked order customers in terms of their direct mail preference in the red. And as you can see, the model adequately finds more responders in the first and second deciles, the dark spaces. If you look at the digital responders across that same spectrum in the green, they distribute sort of randomly. In other words, that direct mail model will not do a good job of finding who's most responsive to digital. So what we do is we take another step where we will suppress who's likely to respond to direct mail, and then redevelop the models to figure out who's going to be responsive to digital. And that's in the middle column, if you will. And as you find is with the specific digital response models, we are now segmenting better who's more likely to respond to a digital impression. So when you combine those two together in total and try to find the right consumers for the right channels, what that enables us to do is to vastly expand our marketing reach. And so much so that typically what we find is you'll find 50% to almost 2 times your audience, and you're able to do that at your targeted returns from a cost per sale perspective. And especially in the digital media channels where you can achieve a lot more efficiency. And now we're assuring that we get the same kind of quality risk from the FQS score, but we're leveraging our ability to tap into channels that are more cost effective. And you combine those together, they make a strong holistic program. And then to Nikki's earlier point, we'll find those that are direct mail only responsive, digital only responsive, or the combination works better. And we'll figure out the right combinations to continuously test and learn our way into expanding that reach further and beyond. Finally, and maybe the most importantly thing is to emphasize is this is at the individual level. So what that enables us to do on the back end is to rematch who are the responders and converters back to the original solicitation files and do that on an individual basis. And that will allow us to have better attribution and attribute results to the channels that were really driving the results. So we could tell who was only presented digital only, who was presented only direct mail only, who was presented a combination of those, and what was the sequence of the combination, and then use that information to not only report and hone our results, but feed that back to our modeling and logic and strategy so that we're further enhancing the programs, improving the efficiencies over time, and trying to basically achieve our ability to increase our reach by getting deeper and deeper in the deciles. Once again, for me, there's 3 key points to emphasize. FQS definitely improves our ability in the digital channels to control for risk quality. Using a customer lifetime value that tweaks the response component by channel helps us reach consumers where they're most effective. And then third, that individual component enables us to have better attribution and fine-tune the programs as we go forward. So back to you, Angela.
Yeah, thank you, Joe. So I think this really gives us a good look behind the curtain as to how all the areas come together to make this work. And I think, Joe, you kind of just summarized it. I think it's important to really hit that message home for everybody that the 3 big differences with this solution is that ability to leverage that credit surrogate data, the ability to onboard the audience in the media platforms at the individual level, big differentiator. And then lastly, that ability to match back the results and attribute them to the media. Thank you both. This was really, really great. I think it's helpful for the audience to also understand the overall business impact that this addressable media solution has made outside of, this particular case study and instances we're talking about. So when we take a look at this solution, how it uses data and predictive models and proven media techniques to acquire, high quality customers, we see that it's driven results for EXL's clients overall. And that impact is being felt in other verticals outside of just banking and financial services. And it's pretty staggering. Impacts like we have here, 65% approval rate at a 1.6 cost per issuance for a lending product, 3 times more efficient cost to acquire for checking versus the industry average. $91 million, this one's great, in loan and deposits in just a 2-month media flight. 2 times greater increase in switching intent after exposure to a brand campaign. Specifically outside of banking, and we're seeing in sectors like insurance, this next staggering statistic is 1.7 reach incremental to mail at a similar quality and efficiency. And that goes back to what Joe was saying about getting your audience past what's being achieved in the direct mail programs. And then 20 points higher average credit than the existing customer base. So With that, I see we have a lot of questions actually that have come in, so thank you all. We want to get to a few if we can, but also if you have any and you want to send them in and we don't get to them, please know we will get to them. We'll get back to you either via email or we can set up time to talk. But with that, Nikki and Joe, I think we're going to take some of those questions. Sound good?
Sounds good.
All right. So the first one I'm seeing here is, how do you initiate this approach and what is involved from the client's perspective? That's a good one. That's one that we hear a lot when our clients come to us wondering, what do they need to do to get started? They see the value in a program like this, but what is the lift? What do they need? Does it work for them? Nikki, what do you say to folks in that instance?
I really say it's actually easier than most people expect. Most clients are expecting coming into this because it does seem pretty complicated, but our team has really developed and refined the playbook for getting started with this addressable media approach. We know all the key areas and we at EXL take on all of that heavy lifting. So while it sounds complicated, that work behind the scenes is really where all the muscle comes from. Typically we start by aligning with the brand on some key factors like objective metrics of success and high-level criteria for their ideal audience to inform that modeling that we start with. In many cases, we work with a client to use their first-party data to build a lookalike audience based on their actual customer data. But first-party data isn't required, especially if we're developing a new plan for a product, a new product launch, and/or a new brand itself.
Mm-hmm.
Also, during this process, we discuss minimal audience sizes that we'll need for a viable test, and any additional services that EXL includes beyond what standard agencies typically will provide in instances like this. Operationally, we onboard with each of the client's critical teams, also to make sure that everyone from legal to compliance to creative to tracking has what they need and is comfortable. Our team has really developed and refined this process over time to ensure that everything is streamlined. We can get to market as quickly as possible to meet whatever needs of the client and to make sure that it's as easy as possible for the client.
That's great. Thank you for that, Nikki. And we've seen that firsthand, the seamless integration with the clients so that we ensure that that heavy lifting is being done by us and that they're just seeing fantastic results. So thank you for that. Okay, I'm going to go to the next question. This one came in early on, so we did address some of it, but I think it's worth kind of diving in a little bit more. This question says, sounds great that you can target the right customer risk profile in banking. Are you able to do this in other industries? Again, I think we covered a little bit of our experience outside of the banking there towards the end, but Joe, from a data standpoint, what are your thoughts on where this method works?
Yeah, in fact, it does, we see it used most effectively in banking, financial, and insurance lines, virtually anywhere where credit will approximate profitability and risk from a quality prospect perspective. But if you step back a little bit, we can just deploy this in virtually any industry where credit becomes a surrogate for profitability. And for me, there's three key points about that. The first that we hit in the presentation was we do not use individual credit data for digital deployment rather. So that enables us to get around some of the FCRA requirements around presentment and tracking. The second piece is, we will leverage the FQS score whenever we feel that credit is the optimization of profitability, and it becomes a real plug and play. However, in other lines where the FQS isn't specifically predictive of the consumer's profitability, we can also build other profitability surrogates and execute in the same way. Again, the critical point is we're able to access the data at the individual level. We do not access credit data at the individual level, but at the summarized level. And we're able to predict what's likely to be a profitable customer from a long-term perspective, and then upload that audience or lookalike audience on an individual basis to enable all the media that Nikki wants to do.
Great. Thank you for that. That's really good. Okay, another question here regarding the FQS model. How do you ensure to avoid bias from a discriminatory perspective? Another good one. We clearly understand the concern about targeting and ensuring we're compliant. Everyone is highly sensitive to any type of bias in that targeting. Joe, can you walk us through, how we can illustrate that that isn't a concern with this solution?
Yeah, great question, actually. So there's really three different safeguards or levels that will apply in this. The first that we already hit was not using individual credit data in digital, but summarized credit, along with some of the information we can access from our third-party data assets at the individual level. But the next step of that is then to run our statistical tests, including t-test and others, to ensure that no individual sensitive variable is driving the result from a financial quality score. And if so, we'll remove that variable out of the consideration set and recalibrate the financial quality score. Thereby, we're able to explain what's in the model, what's not in the model, and why it's not discriminatory from a practice perspective. And then finally, a third and final safeguard is we'll score the model and then look at geographic representation on who we're selecting from the model perspective to ensure that we're not discriminating from a geographic perspective, where we might go into, lower or underserved economic areas. So with those three things together, we're able to address any kind of regulatory or, sensitivity concern within the financial quality score.
Okay. Thank you for that. Thank you. That's really good. Few more coming in here. We have one that says, do most of your clients run this as an evergreen strategy after the 6-week testing period? I can speak, from my perspective and the clients that we work with. Obviously, that 6-week test is an initial test. And then, as Joe and Nikki alluded to, we are constantly learning, feeding that learning in the model for future media. And the goal, obviously, then is always an evergreen. Nikki, do you have any additional thoughts or, again, from like a media perspective, how you see this scalable for some of the clients?
Yeah, absolutely. So to that point, there are definitely differences, and it's a very customized plan that we will create that is based on the audience size that we're going after, because we can't even run these with to current customers if we're trying to hit that person with a new product to try to get them to convert and cross-sell into something else. So it really does depend on the size of that audience. If we have an extremely large audience that we are building lookalike models off of, or a very large customer base that we can continue to hit with multiple products, then yes, we can move that into an evergreen. We will not be hitting them too many times. We have different messaging, we have different products that we can offer them, and we can expand. A lot of times we'll do this even if there is a regional approach. So if we want to take it and say, let's hit the West Coast, let's hit Northeast, let's hit the South, and take it in smaller bites, we can move the media around that way. We can also just continue to expand, especially with some audience targeting that is so wide that we really have the opportunity to continue to refine that model over and over again in the same moment, that we don't need any pauses in the media to let, to bring everything back down to square one, and then come back out with additional media, again, whether it be a new creative message, whether it be new product, whether it just be reinforcing what we had already done. So it is definitely customized, but it is specific based on that audience size and the overall objective of the client.
Okay. Great. I want to be cognizant of everyone's time, but we still have a few questions. So I'm going to try and throw one more at both of you. I have one here saying, given that my clients don't care as much about creditworthiness, but are looking to optimize their media mix, especially digital, can you use your data and skills to help with that? I know the answer to be yes, because we do programs like this that don't incorporate the FQS score, but rely very heavily on the data and analytics side of things, which then feed into the media. But Joe, Nikki, if you guys want to have a closing thought on that one.
Sure, I'll jump in first if you don't mind. Yeah, no, absolutely. Yes is the correct answer, Angela. When we think about that generic paradigm of respond, convert, pay, and stay, really it's tailoring the optimization schema to whatever the client's expectation or KPI is for that program. So in some cases, some clients will be highly focused on respond and convert, and they know the value will grow over time, and they're happy with that. Others are more hypersensitive to, I want to make sure I'm getting a high lifetime value consumer because I know cross-sell is going to be a big element of it. And I need someone that's going to pay and stay and, deposit and earn, so to speak. So yeah, absolutely. It doesn't have to be the FQS score. All the information is available on an individual level, and we will tailor the targeting schema to the client's expectation and KPIs.
Yep, and just to piggyback on that, just to circle back on one of the numbers. So we have over 6,000 variables at our fingertips to be able to leverage and overlay based on what that criteria is. So really the criteria combinations are literally endless in terms of what we can do to try to get the model to the right mix to find that person that you're looking for in the digital space.
Yeah, wonderful. Well, we do still have a few questions, so we will just let the folks that maybe submitted questions that we didn't get to, we are going to follow up with all of those in writing. But again, want to be really mindful of everyone's time. Can't thank everyone enough for joining us today. Nikki, Joe, thank you for sharing your expertise with the group. And we look forward to hearing from maybe some of you in the audience. If you're interested in finding out more about this solution, we would love to talk to you.